Welcome to our video on tax deductions. With tax time approaching, it's important for businesses of all sizes to take full advantage of every tax deduction opportunity available. From small business owners to large corporations, effectively planning your taxes can make a huge difference in your bottom line. But that's not all. We're here to support businesses like yours in learning everything they can about maximizing tax deductions. In the description of this video, you'll find a link to our downloadable ebook on tax deductions, available for immediate download upon purchase. Hit the like button, subscribe, and share this video with your network to get started now. Additionally, unspent funds in an HSA roll over from year to year, allowing for continued investment and accumulation of funds. This can provide a valuable safety net for unexpected medical expenses or future retirement healthcare costs. HSAs can also be used to cover certain non-traditional medical expenses, such as dental and vision care, making them even more versatile and useful. Furthermore, because the funds in an HSA are not subject to federal income taxes when withdrawn to pay for qualified medical expenses, this allows eligible individuals to effectively lower their taxable income by taking out a tax-free distribution from their HSA to cover medical bills such as doctor's visits, prescription drugs, or out-of-pocket costs for medical services. This feature can help individuals manage their overall tax liability, particularly for those itemizing deductions to offset medical expenses. Moreover, for individuals who are self-employed, contributions to an HSA can be made tax-deductible through an employer, making them a valuable tool for reducing self-employment taxes and medical expenses. Additionally, when the funds in an HSA are withdrawn for non-qualified medical expenses, they are subject to taxes and a penalty, although these may be waived in certain circumstances, such as disability or death. Overall, HSAs provide a unique opportunity for individuals to save and grow tax-advantaged funds specifically for future healthcare expenses. HSAs also have higher contribution limits compared to other tax-advantaged accounts like 401ks or IRAs. In 2021, for example, the maximum contribution limit for an individual with self-only coverage is $3,600, plus an additional $1,000 catch-up contribution for individuals age 55 or older. For family coverage, the maximum contribution limit is $7,200, plus the additional $1,000 catch-up contribution. These limits are subject to adjustment each year based on inflation. Another important aspect of HSAs is that while contributions are made with pre-tax dollars, withdrawals for eligible medical expenses are tax-free. This means that if the money in an HSA is used to pay for medical bills, then the owner of the account will not have to pay taxes on that money. If, however, the money is taken out for non-qualified expenses, then it will be subject to income taxes and a penalty, unless the money is rolled over into another qualified medical account or used to pay for qualified health insurance premiums. It is also worth mentioning that when an individual reaches the age of 65, they can use their HSA funds for non-medical expenses without penalty, such as paying for insurance premiums, long-term care expenses, or everyday living expenses. However, withdrawals for non-medical expenses after the age of 65 will still be subject to income taxes. Regardless of whether the funds are used for medical or non-medical expenses after the age of 65, the individual will no longer be subject to the additional 10% tax penalty. HSAs not only provide tax benefits and investment growth, but they also offer increased flexibility and portability. Unlike traditional healthcare plans, an HSA is owned by the individual and can be rolled over from one year to the next without being spent. If the individual changes jobs or insurance plans, they can still keep their HSA and use it to pay for future qualified medical expenses with the same tax benefits. This portability allows individuals to retain control of their healthcare investments even if their employment or insurance status changes over time. Overall, HSAs can be a valuable tool for individuals to save pre-tax dollars for future medical expenses, reduce taxable income, and provide a safety net for unexpected healthcare costs. With tax-deductible contributions, tax-free growth and withdrawals for qualified expenses, and increased flexibility and portability, HSAs can provide long-term financial security for individuals and families looking to manage their healthcare costs and retirement savings simultaneously. Mortgage interest and property taxes are two tax deductions that can provide significant tax benefits for homeowners. Interest paid on a mortgage for a primary residence is generally tax deductible, allowing individuals to decrease their taxable income. Additionally, property taxes paid on a primary residence are also deductible on federal income tax returns, up to certain limits. This means that homeowners can reduce their tax liability each year by deducting the amount they paid in mortgage interest and property taxes. The amount of mortgage interest that can be deducted is limited to the interest paid on up to $750,000 of debt for a primary residence, or $375,000 for a married couple filing separately. This limit applies to mortgages taken out after December 15, 2017. Additionally, the mortgage interest deduction is subject to a phase-out for taxpayers with adjusted gross income above certain thresholds. Despite these limitations, the mortgage interest deduction can still provide a significant tax benefit to homeowners, particularly those with higher mortgage balances. Property taxes paid on a primary residence can also be deducted on federal income tax returns. The amount of deduction is limited to $10,000 per year, which includes all property taxes paid on a primary residence, as well as taxes paid on up to a second home. However, unlike the mortgage interest deduction, the deduction for property taxes is not subject to a phase-out based on income. Therefore, even high-income earners can take the full deduction for property taxes paid on their primary residence. Another important aspect of both the mortgage interest deduction and the deduction for property taxes is that they are itemized deductions. This means that in order for a taxpayer to claim these deductions, they must itemize their deductions on their tax return instead of claiming the standard deduction. Therefore, it's important for homeowners to calculate the total amount of itemized deductions they are eligible for, and compare this to the amount of the standard deduction, to determine which option provides the greatest tax benefit. The mortgage interest and property taxes deductions are important tax benefits available to homeowners. The mortgage interest deduction allows individuals to reduce their taxable income by deducting interest paid on a primary residence, up to a limit of $750,000 of debt, or $375,000 for married couples filing separately. Property taxes paid on a primary or secondary residence are also deductible up to a limit of $10,000 per year, and are not subject to income phase-out. Both deductions are itemized, meaning they must be claimed by itemizing deductions on tax returns. Medical expenses can also provide significant tax benefits for individuals. Expenses paid for medical care, including doctor's visits, prescription drugs, and hospital bills, are generally tax deductible if they exceed a certain percentage of a taxpayer's adjusted gross income (AGI). The percentage is 7.5% for tax years 2021 and 2022, up to a maximum deduction of $7,500 for the total amount of medical expenses that exceed the AGI limit. However, it is worth noting that the Tax Cuts and Jobs Act (TCJA) made a number of changes to the deductibility of medical expenses. The major change under the TCJA is that starting in 2018, the medical expense deduction is only available for medical expenses that exceed 10% of AGI, instead of the previous 7.5%. This means that for tax years starting in 2018 and going forward, deductions for medical expenses are harder to claim, but still available for significant expenses. Additionally, the phase-out for medical expense deductions started at AGI of $27,450 for individuals in 2019, and $27,500 for 2021 and 2022. The medical expense deduction has a few important rules and limitations. First, only unreimbursed medical expenses are eligible for the deduction, so expenses that are reimbursed by an insurance company or paid by an employer are not included. Second, the deduction is only available for medical expenses paid for the taxpayer, their spouse, and their dependents. Third, the deduction is limited to medical expenses that are not covered by insurance, making it primarily for out-of-pocket expenses. Finally, the total amount of the deduction for the year can't be more than the excess of medical expenses over the applicable percentage of AGI. Despite these restrictions, the medical expense deduction can still provide significant tax benefits for individuals who have high medical expenses, especially when they have few other itemized deductions. Since medical expenses are often unexpected and unplanned, having the ability to deduct them from taxes can help offset the financial burden. For instance, an individual who pays $5,000 in medical expenses and has an AGI of $80,000 has eligible expenses in excess of 6.25% of their AGI and may claim a deduction of $3,000, 6.25% $80,000. The actual deduction may be lower if the individual also has other itemized deductions such as mortgage interest, property taxes, and charitable donations, since the combined total of itemized deductions is limited to the total of these expenses. Therefore, individuals who have large medical expenses or other itemized deductions may find that itemizing deductions is more beneficial than claiming the standard deduction, as it can result in lower overall taxes. It is also worth noting that the medical expense deduction can lower the amount of Social Security benefits subject to tax. Since the taxation of Social Security benefits depends on the total amount of income, including tax-exempt income sources, lowering taxable income through deductions can reduce the amount of the benefits that are considered taxable, and thus subject to tax. This can provide an additional tax benefit for individuals who receive Social Security benefits and have large medical expenses. The medical expense deduction allows individuals to deduct eligible unreimbursed medical expenses that exceed a certain percentage of their adjusted gross income, AGI. The limit on the percentage of AGI is 7.5% for tax years 2021 and 2022, but increases to 10% for tax years starting in 2018. The deduction is limited to medical expenses paid for the taxpayer, their spouse, or their dependent. The deduction can reduce the amount of Social Security benefits subject to tax, and can be combined with other itemized deductions to lower overall tax liability. Thank you for watching our video on tax deductions. We hope it has provided some valuable insights to help you stay on top of your tax deductions. For more tax deduction resources, please see the link in the description for our PDF workbook, available for immediate download upon purchase.